Welcome to the Ellsworth Advisors monthly update for April 2024. I'm Kelly Keenan. This is Cameron Mealy. Today we will talk about what's been happening in the economy for the last month or so, our thoughts moving forward, and also how the market has performed and how our portfolio has performed. Cam, why don't you kick us off with some economic numbers?
Will do. Thank you, everybody. Hope everybody's well out there. Kind of biggest news we saw over the last week was the Federal Reserve had their Federal Open Markets Committee meeting on April 30th and May 1st. Kind of true to the playbook that we all expected, the Fed did announce that they are holding interest rates steady. It does not appear at this time that these Fed rate cuts that we were so anticipating are anytime soon. We do still expect to see some rate cuts in the second half of the year, but basically the Fed came out again and said, numbers are not what they need to be. They are not going to be reactionary. They're going to be very pragmatic in their approach. Wait till they see firm data. I think, the one thing that Powell did say that is reassuring is that there are going to be no more rate increases unless we see some significant upsetting of the U.S. economy.
Let's wind back the clock a little bit and go to probably what we were discussing last time. So early March, we had been on about a 5-6 month market run, really no corrections or anything. And at the end of March, early April, inflation numbers were coming in pretty hot. The expectation was for GDP was pretty hot.
The jobs report was very hot.
And all of a sudden, the thoughts of interest rates or the Fed possibly even raising interest rates kind of came to reality. And, April was a tough month, so that really kind of sent the market into a tizzy. And these numbers that Cam's talking about, because they're so recent, kind of changed that tone a little bit.
Yep, absolutely it did. And what we are seeing right now is further proof that inflation is coming down, is not where it needs to be, but definitely an outlook either from the jobs report or GDP that the U.S. economy is slowing. So let's jump into those numbers. Gross domestic product. On April 25th, the Bureau of Economic Analysis reported that GDP increased at an annualized rate of 1.6% in the first quarter. And if you remember from prior videos, fourth quarter came at 3.4% annualized rate. We expect to see approximately a 2% GDP growth in the U.S. That's what we consider healthy for a large economy like the U.S. So 3.4% in the fourth quarter is a huge number. Obviously 1.6%, while not anemic,
expectation
shows a slowdown.
Expectation was 2.4 or 2.6?
2.4.
Right. So a lot less than expectations.
Yep. To dovetail on that and potential slowing down the U.S. economy, on May 3rd, the Bureau of Labor Statistics reported that the U.S. added 175,000 jobs in April. Again, anybody who watched our videos, this is coming down from a 303,000 job increase in March, which last week was ultimately written up to 315,000 jobs. Unemployment rate held steady at 3.9%, but now we're seeing disappointing relative to consensus first quarter GDP numbers. We're seeing jobs report almost cut in half from March. It seems like every month now we are seeing the jobs report revised, so we'll see what the final April report looks like, but certainly we've almost halved from where we came in March. Further reinforcement that the economy is slowing.
So the softness, all the fears of the economy being strong, the Fed continuing to raise rates, which scared Wall Street, slowed down, basically pulled back the market. Now that's just been reversed. That the economy is getting slower, so the Fed will probably cut interest rates. Some strategists are expecting middle of the year, some September, some later in the year, but that's kind of brought some hope to Wall Street that lower rates are ahead of us.
Yeah,
sooner than later.
It certainly appears that increasing interest rates are done with. We could be flatlined for a while, but certainly I think one or two cuts, late third quarter, early fourth quarter, are probably appropriate. Following on, most economists think that then there could be 2 to 3 cuts in 2025, another couple in 2026 until we ultimately get to like a 4% Fed funds rate. Again, to Kelly's point, GDP, jobs report. Now let's talk about where we're at from an inflation standpoint. I'll go quick through this, but the Consumer Price Index, or CPI, on April 10th, Bureau of Labor Statistics reported that the Consumer Price Index increased 0.4% in March and 3.5% on a year-over-year basis. Obviously, 3.5% is way above the Fed's target of 2%. So a little concerning. Now on the better side, on April 11th, Bureau of Labor Statistics also reported that the Producer Price Index, PPI, increased 0.2% in March and 2.1% on a year-over-year basis. Much better news. 2% inflation has always historically been the Fed goal. And so based on that number, we're getting close to that target. Let's check one more number. That's the Personal Consumption Expenditure Index. On April 26th, the Bureau of Economic Analysis reported that Personal Consumption Expenditure Index increased 0.3% in March, and 2.7% on a year-over-year basis. So if you remember, coming out of the pandemic almost 24 months ago, we were experiencing real rate increases, inflation increases of up to 9%.
Right.
And now we brought that down to under 4% and really trending more towards 2.5%. So good news from the inflation standpoint. And last thing I did want to point out, I expect this number to change. But as of May 1st, the Atlanta Fed's GDP Now forecast model is projecting second quarter GDP to come in at 3.3% on an annualized basis. As I said, I believe that number will come down. That is a very data-driven model, and you can't factor in first quarter GDP, these jobs numbers, and what we're seeing anecdotally from other sectors, and not think that number is probably going to come in closer to 1.5% to 2%.
Hard to say. I mean,
you don't expect to see GDP go like this.
Well,
but
it's been bouncing. Some of that being, inventory sell-off, which does not help GDP. If you have some rebuild this quarter, who knows? It's just very unpredictable at this point. The economy's not the economy's not horrible. It's not great. Inflation's still elevated. I think we just keep on churning back and forth for the, I wouldn't be surprised through the rest of the year or
Absolutely.
through the election. I think is a real possibility. Dovetailing into how the markets did. So, like I said, we were on a strong run through March. The market hadn't had any kind of correction since September, October of last year. Nothing beyond 1% or 2%. Market moved to the downside, but it all came in April. S&P 500 in April was down 4.16. Dow Jones was down 5% in April. NASDAQ down 4.41 in April. The Russell 2000, which is small caps, down 7.09. The MSCI EAFE international market down 2.83, so actually better than the U.S. market. And then emerging markets actually gained 0.53%, so that helped the emerging markets, which have been pretty weak for the most part. Year to date, the S&P still at the end of the month was up 5.57%. Year to date, the Dow only up 0.34, so the Dow's been pretty flat. The NASDAQ up 4.3 for the month. Year to date. Russell 2000, small caps down 2.62 year to date. EAFE, developed world, up 1.98%, and emerging markets up 2.17. So still, except for the small caps, still in the black. The reality is, with the better economic news after the flip of the calendar, the market's rallied the last several days. So, much of the negative from last month has
already been reversed out.
Has almost been wiped out. It's early in the month, so we'll see what happens later on this month. Our portfolios, fared pretty well in the down month. Growth with income only down 3% for the month. Year to date, we're still up 6%. Big gainers in April. EOG Resources up 4%. Raytheon up 4%. Our gold position up 3%. Laggards, Nucor took it on the chin, down 14.8%. Lennar down 11.8%. Toyota down 9.7%. Dizzy down 9.2%. Year to date, NVIDIA still leading the pack, up 74%. Berkshire Hathaway up 23%. Raytheon up 21.4%. Our international fund, year to date, still up 11.5%. So we've had a nice little run in international. Year to date, laggards, Nike still down 14.7%, Apple down 11.6%, and J&J down 7%. Dividend yield for the month, April down 3.1%. Year to date up 5.5%. So that's starting to look better on a year to date standpoint. Big gainers, Saliesin up 4%. Kraft up 4%. Southern Company's up 2.5%, so not tons of upside there. For the month, Blackstone down 10.6, Public Storage down 10.6, U.S. Bank down 9. Year to date, Eaton still leading the pack at up 33%, Merck's up at 19%, Waste Management up 16.6, Caterpillar up 14. Laggards year to date, Public Storage down 14. Blackstone, even though it was up, well, Blackstone down 10% in April, and year to date we're down 9.6. So Blackstone's struggling a little bit this year with higher interest rates. Appreciation with income, one of our newer portfolios. April down 5%, kind of in line with the markets. Year to date up 4.7. Gainers in April, Vistra Corp up 9%, Shell was up 7%, BP up 3%. So a little bit of a theme there with the oil companies. Laggards, Kenvue down 12.3, Public Storage down 10.6. Year to date, Vistra still up 97.6, Toyota up 24, which we only added in February, Merck up 19, and Energy Transfer Partners up 16. Laggards, once again, Public Storage popping up again, down 14, and General Digital down 11.2. Price potential, another rough April, down 4.4. Year to date, up 2%. Hopefully we get this thing turned around this month. Interactive Brokers up 3 for April, Timken up 2, Arch Capital up 1.2, Laggards, Integra Life Sciences down 17.7, Graphic Packaging down 11, Jazz Pharmaceutical down 8. Year to date, Interactive Brokers still the biggest winner. That's still in the portfolio, up 39%. Allstate up 22%. If you notice, insurance premium is going up, and they're making money right now.
Yes, they are.
Cigna up 19.7, Timken up 11.8 year to date, and Laggards, Genpact down 11%, and Integra Life Sciences down 33. Our small cap portfolio, as we mentioned before, small caps, down 7% last month. Our portfolio is only down 6. Year to date, we're still up 3 though, versus small caps in general being negative. Big gainers, Argan up 20%, IES up 11.3 last month, United States Lime up 4, Laggards, NC Nino down 22, UFP Technologies down 18. Year to date, Taylor Devices up 124%, Graham Corp up 47, United States Lime and Minerals up 35, SM Energy up 26. Laggards, Northeast Bank down 6, NC Nino down 13.3. Then that's pretty much it. So we fared pretty well for the month. Year to date, we're kind of basically in line in general. When you look at the weighted portfolios, we're staying ahead of the benchmarks. I like where we're positioned for kind of this environment. I don't think much is going to happen on the interest rate front anytime soon.
We don't think anything's going to happen on the interest rate front. We'll keep an eye on jobs numbers, GDP. Obviously, we're starting to enter the summer slowdown season where we do see volumes come down. A lot of people are taking their vacations. A lot of traders on Wall Street are taking their vacations. So we could see a little bit of a slowdown. Obviously, we're going into what is going to be a very contentious election. The campaign season is really kicking off, so expect a lot of headline noise. Remember that just because it's on the TV, doesn't mean it's something that needs to be paid attention to. We're following the real news. What's going on with the U.S. economy? What's going on with our underlying holdings, and making our buy-sell decisions based on those fundamentals, not on the headline risk. You'll drive yourself crazy with the 24-hour news cycle. Just know that we're here. We're looking after your portfolios. As always, we appreciate the trust. And if you need anything, please let us know, and we'll talk to you again next month.
Thank you.
Thank you.